Good morning, everybody. This is Simon Hunt from Dubai. This is the second of our podcasts, which we plan to do every week. If you enjoy what we are saying, you can subscribe to our regular newsletters, which you can find on simon-hunt.com or Substack. They won't be long, but we'll summarize the main developments that are and will affect, and will affect us all. First, the global economy. In the USA, employment data is weakening, first in the private sector and now in government. Housing sales are weak, with Freddie Mac delinquencies now higher than in 2008. Retail sales in volume terms were flat last year, but when a realistic CPI is factored in, they were down and will fall in the first half of this year. Larry Summers and his team worked the CPI methodology back to 1983 and found that CPI actually averaged 8% last year, though our own guru, John Williams of Shadow Government Stats, came out with 10.8%. Households know this, even if the 300 PhD economists in the Fed don't. The US economy will continue weakening into September, by when Trump will be able to introduce his tax cuts, deregulations, and the Fed will be cutting rates and spurring liquidity. Now, Europe. Some funds have moved out of America and back into Europe. Hope is eternal that the early green shoots of a recovery will blossom into flowers. But America's tariff risks, combined with the ongoing war in Ukraine, which some in Moscow define 1925 as the year of military operations, will dampen this enthusiasm soon. Bottom line, very little recovery in France and Germany, balanced by better prospects in Spain and Italy. Now, China. This month's NPC meetings will confirm the stimulative measures agreed at the end of last year. Economic growth should be better than last year, but how much growth will depend on what further measures America imposes on China. Bottom line for the global economy, growth will slow in the first 9 months of this year, but will then start a 2-year inflation-driven economic recovery. Second, equity markets. US equity markets are positioned for corrections into September. Valuations are extreme. Complacency has been replaced by fear. Long-term and serious money has been exiting markets, but short-term players persist in the 2-year mantra of buying the dips. Cash levels at investment funds are historically low. For instance, US equity mutual funds cash as a percentage of total assets is down to just 1.3%, the lowest on record. Attitudes to the market are starting to change. For instance, 61% of investors are currently bearish, the highest ever reading relative to the stock market's drawdown of just 3%. Never in the history of investing have investors been scared by such a small move to the downside. An incoming CEO or president of America would prefer to have the bad news out early as he cleans out the messes left by his predecessor. Bottom line, US and most other global equities should fall by around 20%, with the FANGs or the Magnificent Seven by even more by September. Amusingly, China's Magnificent 10 have outperformed America's Magnificent 7 over the last 8 months. These falls should be followed by 2 years of strong but inflation-driven recovery. Now, third, geopolitical. First, Ukraine. Serious peace negotiations have not yet begun and probably won't for some time. America and Russia have deep, incompatible positions. Talks of deals over Ukraine's critical minerals is a huge feint. What America is really after is access to Ukraine's ultra-rich farmland. Over 70% of those quoted mineral reserves are actually in Russians' controlled territory. Reports from Russia indicates that they are uneconomic to mine. If they were, Russia would have developed them years ago. Russia won't accept a ceasefire. The spring and summer ground conditions will support a ground offensive towards the Dnieper River and beyond. In fact, Russia's troops are positioned for this offensive and are just waiting for the order from Moscow. Bottom line, no early end to the war. Europe thinks they can defeat Russia even without US support in Ukraine and then divide up the spoils. Hope compared with reality is elusive. Israel, Middle East. Netanyahu wants to break the negotiated accord with Hamas, who have regrouped to retain their fighting capabilities. Lebanon's resistance to Israel's attack, even after the ceasefire, have united the country against Israel. The funeral of Nasrallah, the former leader of Hezbollah, was attended by between 1 to 1.4 million in Beirut and shows the testimony of this unity. The war with Israel will continue long after the supposed ceasefires ended, given that country's destruction of villages in the south. Israel has invaded the West Bank with tanks, with the area in turmoil. Syria's internal war will continue with the US-Israeli-backed HTS, or former ISIS government. It will fail soon. Jordan and Egypt are considering military actions. Israel wants to attack Iran, but is being held back by America, whilst Washington tries to negotiate with them, which is happening through back channels. Bottom line, whilst there was hope for peace to settle over the region, the outlook now has grown more murky. Overall, expect 3 years of financial and geopolitical volatility and instability. See you next week. Cheers, Simon.